Part of this story right now is increasingly more information about what's happening with restructurings. Of course, the poster child of this is Evergrande. Reported results in the weekend. It's resuming trade today. This one's going through the floor, isn't it?
Yes. It'll, just like many of the other developers that have resumed after a year plus of activity, Evergrande investors have 17 months of news to react to. So since then, we've had $85 billion of losses that Evergrande has reported over the last 2.5 years. I mean, it's just a gigantic number. Granted, most of it is write-downs, impairments. It's not really operating losses, but still, that size of red ink, plus all the bad news we've seen in property from China over the last year and a half, that's all going to get baked into the stock today.
What do we need to watch in this restructuring efforts right now? So we have the earnings. We're probably going to get a bad day in the stock. We're pushing this forward in what way?
So we have the creditor votes this evening, both in Hong Kong and in the Cayman Islands, regarding the offshore debt restructuring. There are 4 different classes of creditors. The one class to watch is Evergrande Class C. Now that's made up of things such as private loans, some repurchase obligations. That is the group that, as of April, the last time Evergrande gave out any update, that only about 30% or so of people had been backing that support. Now they need to get to 75% for each of the classes in order to be able to get this debt restructuring to move forward to the next step. So that's the group that people are going to be watching, as to whether or not there's been support built up over the last few months from them.
Right. If you could tell us a little bit more too about the housing market and the measures announced on Friday and how that dovetails into just a broader easing of perhaps some of the potential pain that we're seeing.
Sure. We're looking for China is trying to get demand going.
Okay.
And one way to do that is, hopefully they think, is to reclassify who exactly qualifies as a first-time home buyer. So what they're doing is allowing folks who have already paid off a mortgage to again be considered a first-time home buyer, which will allow them to qualify for lower rates than what second and third home buyers currently do.